pick the right stock at the right time. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Before we go into Hot Money, we're going in for some corporate news. Ola is looking to enter the UK market. The country's largest cab aggregator, which recently ventured into Australia, is now going to make its second overseas ventures. Nishant Sharma joins us with all the details. Nishant, they have to wait before they get through to London, right? What's the details that we have?
Well, right, Darshan. So after a big Australia push, Ola is doing its next major overseas push, that is the UK market. And they said in a statement today that they have received licenses to operate in South Wales and Greater Manchester. They're going to start the operation in South Wales within the next month, and they're planning a nationwide expansion by the end of this year. Now, this is the second big market where Ola will be going head-on against Uber, in which both have SoftBank as a main shareholder. Now, Uber has a tough run in the UK market, especially where they had a few license issues. If you remember, in London, the licenses were revoked way back in September last year, and then they were given a 15 months probation to run in the capital of UK. Now, also they have also in the Britain, the license have been revoked by the Britain city for Uber to start to run continuous operation in that city. So Ola is cashing onto that advantage, and we spoke to a couple of analysts, and they're of the view that Ola wants to clearly reach out to SoftBank and to ensure that they're not doing well in the Indian market, but they're in fact doing pretty good in the overseas expansion as well. And if at all there's a need for a consolidation in the market, it should be Ola which should drive the business forward. Now, Ola is offering introductory offers to your drivers on the platform. It's going to offer low introductory commission rate, about 10% for private hired vehicles and about 5% for meter taxi. So it's still a time where Ola will be rolling out its operation in the UK, but it's an interesting move and a big move for Ola.
Okay, Nishant, thanks so much for getting us all that details. We'll watch out for more details as they emerge. We'll move to Hot Money. Let's welcome our experts and independent market expert Dharmesh, Kant, Yogesh, Mehta of Motilal, Oswal Securities, and Vinit Bolinjkar of Ventura Securities join me on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss stocks like Britannia, which came out with Q1 numbers which pretty much were in line with estimates. Arvind came out with numbers which actually the textile division did manage to disappoint there. BSC came out with numbers, and we asked our guests which is one stock they believe that should be accumulated in the near term. It could be a large cap, it could be a mid cap. So that's what we are talking about in the show today. Let's start with the first one, and Britannia. Britannia is down in today's trade. Numbers came in line with what was anticipated. The management also indicating the big rural push that they're looking at new launches, especially in the biscuit segment. What should one do with Britannia going ahead, and how did you analyze the numbers? We'll ask our guests. So Yogesh, I'll start with you. What did you make of Britannia's numbers? Were you happy?
Darshan, the numbers are pretty much seems okay as per the expectation. The margin dip was very much expected because of the raw material cost and the staff cost which has moved up. So there is nothing more of a disappointment. The 15.3% EBITDA margin is also fine. The bottom line number about 260 crores. So overall we are projecting around 1300 crores for this financial year. Okay. But the PE rating, PE is something which is very expensive. So we cannot keep on improving the premium on the 3 years or 5 years average PE rating. So there we believe that now it should be at moderate somewhere. And at this point in time, we will not suggest or will not advise to get into those stocks at this point in time. So overall results are good. There is a one-off that case of other expenses and the higher staff cost. But barring that, they are very much bang on their projections of the expansion plans. Okay, so that's the view in line with what was anticipated by Motilal Oswal Securities. Dharmesh, what did you make of Britannia's numbers? Are you happy?
Yeah, numbers are pretty okay. Nothing unusual about the numbers. Double-digit growth led by both volume and as well as realization was there. Margins were also in line in spite of inflationary pressure. They have been able to maintain their margins well. And the trajectory of the last 5-6 years which they have done, I mean 4-5% kind of a PAT margin to 10%, and that is sustaining as of now because of move towards a premiumization of many of the products is augurs well for the Britannia as a company. So all those are fine, but I think going forward the input pressures will be higher. So how that is being negotiated has to be seen. Management has been aggressive in projecting about their future plans, but that the implementation part I think won't be so easy going forward. And valuations is definitely a concern.
Okay, valuations are a concern. And Vinit, what should one do with Britannia? What do you make of them?
I think the stock is very richly valued.
Okay.
I think it will come in line with those of Nestle. And as the other panelists have said, the results are very much in line. So no great surprises out here. I think the valuations are rich, and as a whole, I'm believing that the Q1 numbers are very, very resounding. So that scare and fear which was there, so you had quality performing and the rest of the market going down into the dumps. I think we're going to have a pullback with valuations coming up, and these quality stocks, premium valuations receding quite a bit.
Okay.
So I think Britannia is the one which has moved the most. So I think it will come off.
Okay, so that's the view that's coming out on Britannia. Three guests do believe that valuations are a concern. Yogesh, you all have active coverage on Britannia. What have you recommended clients to do? Are you changing your rating? What's the target? Have you changed your target price on Britannia?
No, rather we have our target price is 7,300, but current price is 6,200. It is corrected from 6,600 immediately yesterday. So based on that stance, we have a buy rating there, but the valuation of P multiple is a concern. So one has to look at the risk reward ratio as well in investment. If there is any cooling off, or today was the analyst meet, so we have not come out with the active result update report on that. This is just a one-pager note. So we will be coming out with the report on the revise any revision in the price target post the analyst meet today's.
Okay, so 7,300, that means that for a potential long-term hold, but are you recommending your clients to switch positions from Britannia to any other FMCG stocks?
So far, no, we are not recommending, because each and every in the peer category, everything is richly valued. So far, we have not recommended anything on the switch from Britannia to any other in peer category.
Okay, as Vinit said that, he believes that quality stocks, probably the valuations will start coming down. Do you believe to that theory that, some of the mid caps which haven't been performing in their valuations will come up, and some of these richly valued stocks probably you would see a value correction that would come in?
So there are two things: stock price is not performing or business is not performing.
Stock prices.
So if stock price is not performing, definitely they will catch up will be there, because if you look outside the Nifty earnings, they have been very robust and good. So broader market earnings were the thing which is to be looked forward to. And I do think, my own sense is, next couple of years will be a market rationalization. So you will see all these, vagaries or discrepancies which were there, or extremes which were being made, will be set to neutral or will revert back to mean. So from that perspective, yes, you are right. I mean, the stocks which were not performing but fundamentals were in place will start performing, and which were given excess, by the market, so will come down.
Okay. Yeah. So Vinit, I'll come to your point only. You said that you see receding of valuations of some of these high quality names, and probably valuation catch up will happen. For which are the stocks that you are recommending to your clients in the FMCG space, which you believe are attractively priced now?
We like Jyoti Laboratories.
Okay.
HUL is looking extremely good.
Okay.
So it is
despite
cheaper
its valuation.
Yeah. So although 70 times it's optically expensive, if you do a PEG ratio calculation, it is cheaper than the entire lot.
Okay.
And you got 80% ROC, so I think it makes a lot of sense.
Okay. So Jyoti Labs and HUL is something that you're recommending at this point of time. Okay, so that's the view that's coming in on Britannia at this point of time. Despite numbers being in line or decent, at least not finding too much flavor as of now. Vinny does believe that switching to a Jyoti Labs or HUL is a better choice than sticking with Britannia at this point of time. Let's move on to the next stock, and that is Arvind. That also came out with numbers. The brands business did well, but there was an issue as far as the textile business is concerned, just grew 2%. The management says that they believe the 10% growth guidance is in place because they believe that growth will be back-ended. Not too much commentary coming in as far as the demerger is concerned, but numbers overall not the best of numbers from Arvind also. So we'll ask our guests what they believe on the numbers, what they make of it. Vinit, what did you make of Arvind's numbers?
I think it's an opportunity to buy.
Okay.
Okay, and I would be buying to get the brands business at a cheaper valuation, because I believe that in the brand space, they are doing phenomenally well. They've got extremely good growth. Margins are an uptick. Departmental stores are all doing well. You know, and if you see ABFRL, 3 brands, 1,000 crores. Arvind has the biggest portfolio of branded products.
Okay.
So I think it's my top pick in the branded space.
Okay.
So I think there's a delightful opportunity to buy, given the fact that the textile business is down purely because of cotton concerns and duty drawbacks being lower. So I think one definitely should buy into this stock.
Okay, because of the brand business, what Vinit is saying, he is bullish on the counter. Dharmesh, what did you make of the numbers? What's your outlook for Arvind?
So numbers were again pretty okay, no negative surprises out there. But at the same time, if you look at the textile business, the cotton concerns are there. It's the nature of the business. It will be there because of cyclicality, and the cotton prices are likely to rise this time around. So that will again hurt the business in a big way. As far as brand business is concerned, it's more of a B2B business rather than B2C. So again, there the margin constraint is beyond a point you cannot stretch your margins. In B2C, you can take margins to any, you can have a branding, you can have a brand value, and that way the margins are always there in place. So restrictions are there in the business. And if you look at the Arvind stock price, is trading at more than 40 times PE multiple. So all these positives are there. If a business is growing at 10%, ROE is at single digit, margins in lower single digit, and you are getting a valuation of 40 plus. So I don't think there's any scope of re-rating out there in the Arvind.
Okay, that's the way. Vinit, I would want you to respond to his query, but once we finish with Yogesh.
See, overall results are quite okay, and the textile which has given a dent of at least selling 1 million meter lesser, so that has dent the margin and the profitability. So overall, we believe that the value unlock will happen only and only when the demerger of the business will happen, and likely to be management highlighted it will be maybe at the earliest Q2 in FY19. So we will be waiting for that, but definitely at this valuation, it seems that it's a neutral stance. We won't recommend to buy at this point in time.
Okay, that's the view that's coming in. We'll open it up for discussion. He made some valid points saying valuations are expensive, growth is not coming in, return ratios are much lower. So what makes you, are these valid concerns what he's put?
No, I disagree.
Okay.
So one is that they were in an investment phase and you had few brands doing well and a bulk of the brands which are loss making because they're in the build out stage. But now what is happening is they are demerging the company, which is a clear sign that the brand's business can run on its own. Okay, so I don't see any further capital being employed. It will run on internal accruals. So obviously ROCs will improve. And as you have so many power brands and you have the other brands which are now kicking off, and you will have about 75 bips to about 100 bips of margin accretion every year. And you're going to move from a 3,000 crore portfolio to about 9,000 by 23 to 24.
Okay.
You know, and if you consider the organized or unorganized shift, you know, it's not even 1% of the entire textile space, right? And we are seeing the flurry happen. We also have got unlimited out here, okay, to cater to the value markets. So it's a very great strategy. You have value mart on one side, and you have the brands on the other side. Okay, and I think it's a great combination where you know, aspirations are growing, and we are, you know, at that exact magic moment of 1990s where Gap and the other big stores of the US were, you know, so they became the darlings of the Wall Street. So the same story is going to pan out here.
Okay, Yogesh, you also pointed out that demerger will play out. In case the demerger works out, and I think the consensus is that the brands business will grow significantly, shouldn't an investor wait for the demerger to happen and buy only the brands business rather than the textile business which is not doing well or the engineering business which is not doing well?
See, there are two things there, Darshan. You cannot make out that, you know, at this point in time, if I buy, then the downside risk is limited, and I will might as well in next 2 months or 3 months or 2 quarters, I will get the business demerge and separate listed entity, and value unlock will happen. So that question mark is always there. So you cannot time that time at 4:30 you buy or at 3:80 you will buy. I'm not sure.
Okay.
So that unlocking will happen, but once the record date and the regulatory approval in place, and then we can decide about, you know, again, now it's a buy.
You don't believe that since it's been a while since the announcement came in, the stock prices have also reacted. You don't think that the current price reflects the valuation of the demerger that is going to happen?
Current price is reflecting at at around 6 times EV to EBITDA for the textile segment and 20 times for the brand and retail segment. So Unlimited is doing very well. They're expanding, and innerwear segment they are planning to expand by 50% over next 2-3 years. So it's a story over long-term building. It's not an overnight story. So even we will wait for a brand and retail and the textile business to be demerged. We have enough time to decide.
Okay, so that's the view that's coming in on Arvind. Dharmesh, not too bullish about the counter. Yogesh, at this point of time, Motilal Oswal has a neutral view, and Vinit here is rather bullish. So you got all three sides of the story for Arvind on this forum. Let's move on to the next stock, and that is BSE. Now, numbers did manage to disappoint. What's the view going ahead for BSE? BSE now at almost 800. What's the view going ahead? We'll ask our guest. Dharmesh, what did you make of BSE numbers?
As you rightly said, numbers managed to disappoint. So see, the crux of the thing is exchange business will grow at the rate of 5 to 10%. Higher band is 10%. That would be a phenomenal achievement if they are able to do it. 5 to 7% is the top line and bottom line growth which will be there. Margins will always be low. It's not a very big margin play. And for BSE, even the return ratios are very low. They are single-digit return ratios. And valuation wise, okay, fine. Since the nature of business is such that this revenue model is like an annuity kind of play with a 5% plus minus depending upon how the markets are panning out. So their 20 times PE multiple, if you are giving a stock, is fine, but not beyond that. So even from a long term, and see, the competition is rising. Competition is rising in a very fast way. NSE has still not come up with the listing. So the real play we start when NSE listing is done.
Okay, so that's the view. Yogesh, you all have active coverage on BSE. What have you recommended clients on BSE? What do you make of it?
On the number prima facie, it's quite dismal numbers. It is not so encouraging that it will be enthused to the investors that one should buy. And the story on the long term does not play well for as a long term play, because NSE is there for the competition. Yeah. So we should not forget that key criteria. Though we have active coverage, we have buy call on that with a price target of 15-20% upside from the current level. But what I feel is that the turnover, which was at in the Q1 it is at 33 billion, and last year it was around 44 billion per day average. So that has gone down significantly, and mid and small cap companies stock prices which have gone down, so that has dampened the turnover and the earnings on the BSE. Apart from that, new listing were not much in the Q1, so that the fees has been settled off again the profitability. So we believe that it's not so much of a robust kind of a revenue model where you see in the consumption sector or anything in the NBFC sector. So it's a quite okay type of a result.
Okay, so that's the view that's coming in. And Vinit, what did you make of the numbers?
So I think the most disconcerting thing was that their market share after a 550 basis points fall is at 10%. So you're actually seeing 33% erosion in market share. That's very bad. Having said that, I think that the maximum damage has been done because BSE had its cliche of having certain stocks which are not listed on the NSE, right? But those stocks have been have the ghost of the ASM haunting it, So it will be a while before this kind of thing improves. But on the other side, the dividend yield is about 3.5, and the bad times don't last. Our country is firmly on a good wicket, so I think those things will come up. And they have got 28% cash, out of the total turnover, 28% is coming from other income. So that can be used for buybacks.
Okay, so probably that could be the potential triggers for BSE going ahead. We'll open it up for discussion. Vinit, given the fact that it's the only play as far as equity exchange is concerned. Obviously, there's MCX and there are news of MCX and NSE getting together. Is there any scope except for this dividend yield and cash on the books for someone to buy BSE at least for the long term? Is there any trigger you'd see apart from these two?
So they waived off certain charges on the BSE 30 stocks. So now they've started charging them again. So that is a little bit of revenue potential out there. But I think it's a dismal state of affairs, because if MCX and NSE get together, BSE will be completely marginalized.
Okay, and will this, if the news say that the derivative trading again that will start from in the second round, probably from October, November, will that help BSE in any way?
Marginally, but
okay,
it's not. If I can do everything on NSE, I'm not coming to BSE.
Okay, that's the view. Dharmesh, any positive triggers on BSE?
I don't think so. I totally second what Vinit has said. And eventually it will be, one exchange which will be ruling. Because if you have an option to trade a stock So NSE, BSE both is there, and you have a seamless trading in NSE as well. And where the trust seems to be more higher because of it is being regulated by government or owned by government. So that's one psychological factor which aids NSE in garnering the business more. So why you will go and trade in BSE?
Okay, Yogesh, what have you all recommended? You all, what's the target that you all have given on BSE? And is there any positive triggers that you all have in your note that probably indicates any kind of re-rating that could come in on BSE?
The re-rating the trigger will happen only and only if the mutual fund platform, which is right now at a very significant, not so insignificant. So if that materializes with the AMC business, which everybody is talking about, that that the asset under management or the mutual fund business will grow. So that is the only platform which BSE is providing, not the NSE. If you want to buy and sell mutual fund, so that is very niche segment right now, and they have got a cross-holding in CDSL. So provided there they can garner some kind of a value unlocking from there. And core business is around 50% of the business core income, and as the float income and margin are combined together. So we are not recommending at a gun go that yes, it's a screamy buy, but it could be we have a coverage as a buy, but it does not mean that one should go and buy in the portfolio.
Okay, so that's the view that's coming in on BSE. Not too enthused, I guess, not too enthused with the numbers that they saw or even the future potential for BSE going ahead. And the last stock we want to talk about is since markets are at these levels, probably where even the mid caps have now started contributing. We are asking our guest what are they recommending to their clients. It could be a large cap, it could be a mid cap. So that's what we are asking. Yogesh, I'll start with you. Which is the stock that you are recommending to your clients, and what's the rationale?
Darshan, now the markets are on a highs, and even large cap have shown a decent run up. But still, we like HDFC Limited as a parent company and having subsidies under them. So there we like this business because it will provide at least the risk of the potential downside risk is very less, and upside could be value unlocking, and the subsidy could be well. Retail loan book and corporate loan book both are growing by 18%. So overall it's a 4 trillion kind of their AUM, and they're managing very well. Now if we consider on the subsidy side, then HDFC Bank and HDFC Standard Life and now the AMC which has got listed, so that value unlocking will happen, and share the per share on the SOTP basis we are valuing at 2335 on the individual valuation. If we consider, it comes at 2335 rupees per share as a FY20 target. So we believe that it's quite a healthy growth of at least 20-22% CAGR over last 5 years. Now it has tapered down to somewhere around 18%, but it's a decent buy from
okay, it's a compounder. It's a stock that you would say that buy as a compounder?
Yes, it is a buy as a compounding valuation.
Any risk on HDFC?
So far not visible, because spreads are maintained at around 2.28% and NIMs are also very much stable, and asset quality is not a concern at all right now. GNPA is around 1.2% and NPA is at 0.8. Okay,
in the NBFC coverage or the housing finance company coverage that you have, would HDFC be the top pick that you all are recommending your clients?
HDFC is not only the housing finance play, but we have a DHFL as well in the housing finance companies where we have a top pick, and even Grow Finance at 12 times price to book we are considering. So it is a similar kind of a group.
And you are okay with the valuation that HDFC commands?
Yeah, we are okay with that. Yes.
Okay. Dharmesh, which is the stock that you would recommend?
It's from mid cap space, Canfield Homes, housing finance company. The stock price has corrected significantly. It went up because of it was on the block by the Canara Bank. They wanted to sell their off. So I think that again will play out over next few months. And the company is good. Company has been doing fairly well. Last quarter earnings were very good, 17% kind of a loan book growth and 11-12% kind of a profitability growth. Management sounded very aggressive on the stock. They said about 26% CAGR on the loan book growth for next 3-4 years. So currently the loan book is around 16,200 crores. They want to take it to 40,000 odd crores. Okay. So that will give you a visibility of 20-25% of a CAGR on a book value and earnings of the company. Asset quality is very sound. 0.44% is the GNPA, 0.22% is the net NPA. 90% of the book is home loans. Of the total loan book, 72% belongs to salaried and professional employees. So that way they are insulated to market vagaries. 18 lakhs, 20 lakhs is the home loans they provide, and SME segment is 8-9 lakhs kind of a book they provide. So seeing the economic trend, these are the segments which will flourish going forward. So I think it's a decent buy. Valuation wise okay, but 25% kind of a CAGR if you expect. So 480 is the target price I am looking forward to based on FY20.
Okay. Will the change of management, if it does happen, will that be a re-rating
definitely, because the company is good, everything is fine, and I think an aggressive management if it takes over or a private management takes over, it will definitely be re-rated.
Okay, that's the view that's coming in. Canfin Homes, HDFC, pretty much in the housing finance space. And what about you? Which are the stocks that you like?
So just a preamble, we just last week we did a survey of the entire space. So Nifty 500 showed up results of about 250.
Okay.
82 were outstanding.
Okay.
So we think being in that space rather than going lower is looking appealing.
Okay.
And in that I think ITC, which is the cheapest stock, is one that we like.
Okay.
So purely because I think on ITC the volume growth has started. We've seen 5 years of decline on cigarettes. That is coming back. That is number one. All the other three segments have registered double-digit growth. So yeah, FMCG 10%, 12%. Your not paper. 12% is hotels and 14% was agri. And although paper did flat growth, 5 crore profit became 50 crores. So completely all the segments are firing now. So I believe that we can see growth coming in very aggressively out here.
Okay.
And in the FMCG space, when you're valuing all stocks at 40-50 times, I think this stock is going to get its turn.
No, but the problem with ITC, the reason it's trading at almost half the time of valuation, despite having more revenues or pretty much have similar profits with HUL, is the fact that it has the tag of a sin stock, because majority of the revenue numbers or revenue still comes in from cigarette.
Yeah.
So is that not some time over? People have said that it's undervalued to this thing, but somehow the stock price doesn't reflect that.
So all the businesses were bleeding. So hotels was not doing well. Paper was down in the dumps. FMCG was struggling to break even. All that has suddenly now gone. We are looking at double-digit numbers next year in terms of margins. Okay. So when we are seeing this kind of growth coming in out here, and the sin tax collections for the first 2 months are much ahead of estimates what the government wants. So if you annualize that, you're 200 crores higher.
Okay.
So with that kind of collection, I don't see anything coming in now. And and if the GST collections are buoyant, maybe next year also it might not be in the eye of the needle.
Okay.
So keeping these things in mind, I believe that you could have 5 to 7% growth in top line on on cigarettes, which goes entirely to the bottom line.
Okay.
Right. So I think great story out here under the radar, and I think there's a lot of move that can come out.
Okay, so ITC, I believe you had one more stock that you wanted to speak about, Petronet.
So yeah, Petronet. So I think it's a no-brainer. It only has a little bit of holding period. So the capacity expansions will come in from next year, right? So you'll have 2.5 million ton coming in from Dahej. Once the pipeline is laid out in Kochi, at 10% capacity utilization go to 35%. On the east coast, you're coming up with Gangavaram, and you got talking to Sri Lanka and you're talking to Bangladesh. So I think there's a neat story of capacity expansion taking place out here. Of course, there are competitions coming in, but the CGD story itself is so big. Okay. So demand for gas is going to be around, and this guy being there. And one more thing is that the government is looking at direct LNG to buses and trucks. Okay. So we need to figure out how that is going to play out. But I think that stock at about 14 times FY20 is very cheap. It has traded about 20 times.
Okay.
So that looks good. Okay,
Petronet as well as ITC are the stocks that Vinit has spoken about. Canfin Home is something that Dharmesh spoke about. And the big one, HDFC, is something that Yogesh should mention in trade. But with that, we're completely timed out on this show. Vinit, thanks so much for coming. Dharmesh and Yogesh, thank you so much for coming in the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.